All right, Andrew John here, and I need you to lock in for the next few minutes, because what I'm about to show you is not a theory. It's not speculation, and it's definitely not another financial news cycle that disappears by next week. This is the kind of story that gets handled quietly behind closed doors, and only becomes public after the damage is already permanent. On March 28th, 2026, three regional banks, with combined assets exceeding $89 billion, failed their Federal Reserve stress tests. And I don't mean they barely missed the mark. I don't mean they failed on a technicality. I mean they failed catastrophically. The kind of failure that, in plain English, means they don't survive the next real shock. And within 72 hours, internal documents from the FDIC's own risk assessment division started circulating among institutional investors. Not the public, not the media, institutional money. And those documents showed something that should make every American depositor stop and think. The FDIC's Deposit Insurance Fund, the pool of money that is supposed to protect your deposits up to $250,000, is functionally insolvent at current reserve ratios. Let me say that again because this is the part that changes everything. The FDIC Insurance Fund, the thing people rely on to feel safe, is running on fumes. And no, you're not going to see this on CNBC. You're not going to hear the Treasury Secretary announce it at a press conference. Because this isn't the kind of crisis they broadcast. This is the kind of fracture they manage quietly. They paper it over with emergency facilities. They hide it behind temporary measures. And depositors only find out after their account access is frozen over a weekend. Now here's the part most people don't understand. These three banks that failed, they're not household names. But their exposure is. Between them, they're sitting on over $47 billion in commercial real estate loans, $18 billion in underwater treasury holdings from the 2020 to 2021 zero-rate era, and derivative books that are marked to model, not marked to market, which is a polite way of saying the losses are real, but they're being hidden by assumptions. And the stress test scenarios weren't extreme. They didn't assume the world ended. They assumed a moderate recession, a 200 basis point spike in long-term rates, and a 15% decline in commercial property values. That's it. And under those conditions, all three banks showed negative tangible common equity within 18 months. And if you don't know what that means, here's the translation. That means insolvency. That means the bank is dead. That means your deposits become part of the wreckage. And yes, that means bail-in risk. Now listen carefully, because this is what makes 2026 different from every other banking scare you've heard in the last 5 years. The FDIC's Deposit Insurance Fund currently holds around $129 billion in reserves. And to most people, that sounds like a massive number, until you realize that insured deposits in the United States total over $10.5 trillion. $10.5 trillion. That means the FDIC is backing the entire U.S. deposit system, with a reserve ratio of roughly 1.23%. And it gets worse. The legal minimum mandated by Congress is 1.35%. We're below the statutory floor, below the legal minimum, right now. And here's what happens next if even one of these three banks goes into resolution and triggers a payout. The reserve ratio drops below 1%. For the first time since the aftermath of the savings and loan crisis in 1991. And once it drops below 1%, the FDIC only has two real options. Option 1, levy a special assessment on all other banks, which means forcing healthy banks to pay an emergency bill. And what does that do? It tightens credit conditions immediately. It accelerates stress. It spreads the problem. Option 2, go to Congress and request a Treasury backstop. And that means what nobody wants to say out loud. Taxpayer-funded bailouts are back on the table. But here's the mechanism almost nobody is talking about. And it's the reason you should be paying attention right now, not later. Under the 2010 Dodd-Frank Act and the subsequent amendments finalized in 2018, the FDIC has authority to implement what's called orderly liquidation before a bank technically fails. That means they can step in early. They can take control. They can wipe out shareholders, haircut bondholders, and convert uninsured deposits into equity in a bridge institution before the bank's capital ratios even hit zero. This is not a conspiracy theory. This is written authority, and it has already been tested. Silicon Valley Bank, March 2023. That crisis was contained using emergency systemic risk exceptions. But the playbook? The playbook is now established. So here's the brutal truth that most depositors still don't understand. Your deposits above $250,000 are not cash. They are unsecured liabilities on the bank's balance sheet. In a resolution scenario, you are a creditor, not a depositor, and creditors take losses. Now, in the next 28 minutes, I'm going to walk you through exactly how we got here, why the reserve ratio is structurally unsustainable, what the failure of these three banks signals about the broader system, and most critically, the three moves you need to make right now to protect your wealth before the resolution process accelerates. This is not about timing a crash. This is about understanding that the crash is already in motion. It's just moving slowly enough that most people won't see it until their account access is frozen over a weekend. So stay with me, because what I'm about to show you is the difference between preserving generational wealth and watching it get converted into worthless equity in institutions that no longer exist. Before we go further, you need to understand the foundational framework that governs every modern banking crisis. Because once you see this, you can't unsee it. Banks operate on fractional reserve principles. For every dollar you deposit, the bank keeps a small fraction in reserve and lends out the rest. This works perfectly fine as long as depositors don't all ask for their money back at the same time. But the moment confidence breaks, the moment depositors start pulling funds faster than the bank can liquidate assets, the system collapses. The FDIC was created in 1933 specifically to prevent this. The idea was simple. If the government insures deposits, people won't panic. They won't run on banks because they believe their money is protected. And for 90 years, that system worked. But it only worked because the reserve ratio, the amount of money the FDIC keeps relative to insured deposits, was high enough to cover multiple failures. Now, let me show you how close we've been to the edge before. In 2009, at the peak of the financial crisis, the FDIC reserve ratio dropped to 0.116%. That's not a typo. 0.116. The fund was effectively insolvent. It went negative. The FDIC had to borrow from the Treasury just to keep operating. And it took a decade of special assessments on banks to rebuild that fund back to the statutory minimum. Now, in 2026, we're right back at the edge. And here's why this matters more than most people realize. The reserve ratio isn't just a number. It's a confidence mechanism. When institutional investors see that ratio drop below the legal minimum, they start asking questions. They start stress testing their exposure. And they start moving money, quietly, aggressively. And we are already seeing it. In the first quarter of 2026, wholesale funding markets saw roughly $87 billion in outflows, from regional banks into money market funds and short-term treasuries. That's not retail depositors panicking. That's sophisticated capital exiting. And once that exit becomes visible in the Fed's H.8 data, the game is over. Because fractional reserve banking only works when reserves don't have to be used. The moment the FDIC actually has to pay out depositors at scale, the fund depletes, confidence collapses, and you get a cascade. This isn't theory. This is exactly what happened in 1931, in 1991, and in 2008. The only difference now is the tools available to policymakers. And as you're about to see, those tools are far more dangerous to your wealth than an outright bank failure. To understand why this moment is so critical, you need to recognize the pattern, because this has happened before. Not once, not twice, 3 times in the last century. And every time, the people who recognized the early warning signs and repositioned their wealth were the ones who came out ahead. Let's start with the Great Depression. Between 1930 and 1933, Over 9,000 banks failed in the United States. Most people remember the stock market crash of 1929, but the real devastation was the banking system. Those banks didn't fail because of one single event. They failed because they held long-term loans, collateralized by assets that collapsed in value. Real estate, corporate debt. When depositors started withdrawing funds, banks were forced to sell those assets at fire sale prices. That realized losses. Those losses destroyed capital. Destroyed capital triggered more withdrawals, and the spiral fed itself. Back then, the FDIC didn't exist yet. If your bank failed, your money was gone. So the Roosevelt administration responded in two ways. They created the FDIC to restore confidence, and they implemented Executive Order 6102, forcing U.S. citizens to turn in gold. Then, once the government centralized the gold supply, they revalued it, which effectively devalued the dollar. This was a wealth transfer. People holding cash and deposits lost purchasing power. People holding hard assets preserved wealth. And the lesson is not that gold confiscation will happen again the same way. The lesson is that during systemic banking crises, the government changes the rules. And if you're positioned inside the blast radius, your wealth becomes collateral damage. Now let's jump to 1991, the savings and loan crisis. Less famous, but extremely relevant. Between 1986 and 1995, over 1,000 savings and loan institutions failed. These institutions specialized in residential mortgages, and they were destroyed by the same interest rate mismatch we're seeing today. They borrowed short-term from depositors at low rates and lent long-term into 30-year mortgages. When rates rose, their portfolios collapsed in value. They were insolvent, but regulators allowed them to keep operating. A fancy term called regulatory forbearance, which basically means pretend the problem doesn't exist until it becomes uncontainable. By 1989, Congress had to create the Resolution Trust Corporation to take over failed institutions and liquidate assets. The final cost to taxpayers? $132 billion. About $300 billion in today's dollars. And here's the key point. During that period, depositors in failed institutions faced delays, haircuts on uninsured balances, and in some cases, conversion of deposits into equity in bridge banks. If you had more than the insured limit, you lost money, not because you made a bad investment, but because the system was insolvent and you were last in line. Now, the third parallel, and you already know this one, but what you may not know is how close we came to a full systemic collapse. In September 2008, Washington Mutual failed, largest bank failure in U.S. history at the time. The FDIC seized it on a Thursday night and sold it to J.P. Morgan Chase over the weekend. Depositors were protected, but only because J.P. Morgan took the deposits. If J.P. Morgan had walked away, the FDIC would have been on the hook for around $188 billion in insured deposits. And the Deposit Insurance Fund back then, it had roughly $45 billion. One bank could have wiped it out. 1 week later, Wachovia failed. $800 billion in assets. Again, the FDIC arranged a sale, avoiding a payout, but the fund was hemorrhaging. By the end of 2009, the deposit insurance balance went negative for the first time since the Great Depression. The FDIC had to borrow from the Treasury and implement emergency assessments on all banks. And here's what almost nobody talks about. During this period, the FDIC seriously considered bail-ins for uninsured depositors. The legal framework was already being drafted. It just wasn't needed because the Fed and Treasury stepped in with TARP and quantitative easing and unlimited liquidity. But that framework, that authority, it got codified in a law 2 years later. Dodd-Frank, which means in 2026, we're not in the first cycle, we're in the fourth. And this time, debt levels are higher, asset bubbles are bigger, and policy tools are exhausted. The Fed can't cut rates to zero without reigniting inflation. The Treasury can't do another TARP without Congress. And Congress is gridlocked. And the FDIC reserve ratio is already below the legal minimum. which means the next failure will not be resolved the way 2008 was resolved. It will be resolved the way Cyprus was resolved in 2013. Depositors will take losses, and most people still have no idea it's even possible. Now let's talk about what happened on March 28, 2026, and why these three bank failures are different. The names of the banks are not public yet, because the Federal Reserve embargoed the stress test results under emergency confidentiality provisions. But the asset profiles have been leaked through institutional channels, and the numbers are damning. Bank A, a regional institution based in the Southeast. $34 billion in total assets. 68% of its loan book is commercial real estate, office buildings, retail centers, multifamily housing. The stress test assumed a 15% decline in commercial property values and a 200 basis point rise in the 10-year yield. Under those conditions, Bank A's tangible common equity went negative within 12 months. And the reason is simple. Those CRE loans were originated between 2018 and 2021, when property values were at all-time highs. Now remote work permanently reduced office demand. Retail is facing structural decline from e-commerce. Those properties are worth 20 to 30% less than the loan balances. And here's the trap. The loans are coming due in 2026 and 2027. Borrowers can't refinance at current rates. They default. The bank forecloses. The bank sells at a loss. Losses hit capital. Capital goes negative. And once capital goes negative, the bank is dead. Bank B, a Midwestern institution with $29 billion in assets. Different problem. Same outcome. 53% of its balance sheet is invested in U.S. Treasuries and agency mortgage-backed securities, purchased during 2020 and 2021 when the Fed was doing unlimited QE and yields were basically zero. Those securities are now underwater by around 18%. Now, yes, if the bank holds them to maturity, they recover. But banks don't get that luxury in a crisis, because when deposits leave, the bank needs liquidity, and liquidity means selling. With a stress test assumed another 200 basis point spike. Those unrealized losses turned into realized losses. The bank was forced to sell to meet liquidity demands. Capital went negative. Insolvency. Bank C is the most troubling. $26 billion in assets, concentrated in agricultural lending and energy exposure. The stress test assumed a 25% decline in agricultural commodity prices and a $15 per barrel drop in oil. Both are historically normal moves. Under that scenario, loan loss provisions exploded. Farmers default, energy companies default, and capital goes negative within 18 months. Now here's the mechanism that makes this systemic. These three banks are not outliers. The Fed's confidential stress test covered 47 regional and mid-sized banks. Of those 47, 12 failed under the baseline scenario. 12. That's a 25% failure rate. Under conditions that aren't even extreme. A moderate recession. A rate spike that simply returns to historical norms. A decline in asset prices less than half of 2008. And a quarter of the banks still failed. The aggregate assets of those 12 banks exceed $340 billion. The FDIC insurance fund holds $129 billion. Do the math. If even 4 of those banks go into resolution within the same quarter, the deposit insurance fund is effectively gone. And that doesn't even include hundreds of smaller community banks with the same exposures that weren't included in the stress test. The Fed knows this. The FDIC knows this. The Treasury knows this, which is why their response has been quiet. On April 2 ND, just 5 days after the stress test failure, the Fed announced a new standing repo facility for regional banks with expanded collateral eligibility. Translation: they're allowing banks to borrow against underwater securities at par value, which is basically an accounting illusion. It hides losses. It buys time. And on April 17th, the FDIC issued updated guidance on bridge bank authorities and orderly liquidation procedures. Translation: they're preparing the legal framework to take over failed banks. without triggering depositor panic. These are not the actions of regulators who are confident. These are the actions of regulators who are trying to prevent a stampede. And the clock is running out. Now let's talk about what this means for you, for your deposits, and why the FDIC being out of money isn't a technical problem. It's an existential one. Deposit insurance is supposed to work like this. You deposit money. The bank pays a premium to the FDIC. If the bank fails, the FDIC steps in, makes you whole up to $250,000, and either sells the bank or liquidates assets to recover funds. That system works as long as two conditions hold. 1. Failures are infrequent enough that the fund can absorb them. 2. The government is willing and able to backstop the FDIC if it runs dry. In 2008, both conditions held. In 2026, they do not. Federal debt is now over $36 trillion. Interest payments exceed $1.2 trillion annually, more than the defense budget. Congress is gridlocked. There is no political appetite for another bailout, especially in an election year. And the Fed is trapped because cutting rates risks inflation, but keeping rates high risks bank failures. So when the reserve ratio drops below 1% and the fund becomes functionally insolvent, the government's options narrow dramatically. They can levy special assessments on banks, making the crisis worse. They can request a Treasury backstop, which requires legislation and time, which creates delays, which triggers panic. Or they can implement bail-ins, convert uninsured deposits into equity, haircut bondholders, wipe out shareholders, and do it over a weekend, under emergency authority. And yes, that authority exists. And yes, the precedent exists. Cyprus 2013. Depositors over the insured limit lost up to 47.5% in a single weekend to recapitalize banks. It wasn't a bailout. It was a bail-in. And the same mechanism exists in U.S. law. If you have more than $250,000 in any single institution, you are holding an unsecured liability, not cash. You are a creditor in a potential bankruptcy, not a protected depositor. Now, here's the part that matters. Understanding this is useless if you don't act. So let's talk about the 3 asymmetric moves you need to make right now. Not next month. Not when the news finally catches up. Now, move 1. Deposit diversification below insurance limits. If you have $500,000 in cash, do not keep in one bank. Spread it across multiple institutions, each holding no more than $250,000 per depositor per institution. This sounds basic, but most people don't do it because it's inconvenient. They want one relationship, one login, one statement. That convenience is going to destroy people when they're caught above the limit. And here's what most people still don't know. The $250,000 limit is per depositor, per institution, per ownership category, meaning you can increase coverage using different account structures. Personal accounts, joint accounts, trust accounts, business accounts. Each can be separately insured if structured correctly. You can keep over $1 million insured at one institution, but only if you set it up before the failure. Because once the bank fails, it's too late. The FDIC determines coverage based on account titles at the moment of failure. Move 2. Rotate a portion of liquid wealth into physical precious metals held outside the banking system. And I need to be crystal clear. Not gold ETFs, not digital gold, not bank-managed storage programs. Physical metal, coins or bars, either in your possession or in a private vault, with segregated allocated storage, where you have direct legal title. Why? Counterparty risk. Every financial asset you hold, cash in a bank, stocks, bonds, is a claim on someone else, an IOU. And in systemic crises, IOUs default. Gold and silver are the only assets that are liquid, portable, and have zero counterparty risk. Nobody can bail in your gold. Nobody can convert it into bridge bank equity. Nobody can freeze access to it. It is final settlement. And when confidence collapses, physical metal goes parabolic. We saw it in the 1970s. We saw it in 2008. And we're seeing it again. Central banks have been accumulating gold at the fastest pace in decades. Not because they think it's a trade, because they know the dollar-based system is structurally stressed. If sovereign nations are doing it, you should consider doing it with at least 10 to 20% of your liquid net worth. Move 3. Strategic exposure to distressed asset funds and countercyclical equity. This is the move that separates wealth preservation from wealth multiplication. When the banking crisis accelerates, when those 12 banks that failed stress tests begin entering resolution, distressed assets will flood the market. Commercial real estate at 40 cents on the dollar. Underwater loan portfolios sold in bulk. Entire business lines liquidated. And a small group of institutional investors with dry powder will buy those assets at generational lows. This is exactly what happened in 2008 and 2009. Blackstone, Brookfield, Oaktree, they raised billions at the peak of fear, deployed it at the bottom, and generated 25 to 40% returns over the next decade. The asymmetry is obvious. Buy tangible assets at distressed prices, limited downside, massive upside, and for retail investors, the cleanest way to access this is through publicly traded vehicles designed for distress cycles. Business development companies, closed-end distressed debt funds, specialty REITs preparing to deploy capital. You don't need to deploy everything today, but you need to know where you'll deploy before the opportunity becomes obvious. Because once it's obvious, institutional capital floods in and the window closes. Now let's connect the final dots. Because what I've just described is not an isolated event. It's a symptom of a structural problem. Global debt to GDP is at all-time highs. Real rates are positive for the first time in over a decade. Debt service burdens are exploding. Asset prices were inflated by 15 years of zero rates and QE. And now the monetary tide is going out. And we're finding out who is swimming naked. These 3 banks that failed stress tests are the canary in the coal mine. They're the weakest links in a chain under systemic stress. And once one link breaks, contagion spreads. This is not a matter of if. It's a matter of when. And the policy response will not be a clean bailout. It will be a bail-in. Uninsured deposits converted into equity. Depositors turned into creditors. And most people will find out after the rules have already changed. The mainstream media is not going to tell you this. They will tell you the system is safe. They will tell you deposit insurance works. They will tell you regulators have it under control. And they will keep telling you that right up until the moment you log in on a Monday morning and realize your money is trapped. So here's what I need you to do right now. Go through every bank account you have. Add up total deposits at each institution. If any single institution holds more than $250,000 of your money, move the excess immediately. Open accounts at other banks. Structure accounts properly. Do whatever you have to do to stay under the insured limits. Second, allocate a minimum of 10% of your liquid net worth into physical gold and silver. Not paper claims. Physical. Treat it as insurance, not a trade. Third, start researching distressed asset vehicles and counter-cyclical strategies. You don't need to go all in today, but you need to be ready because the liquidation wave doesn't last long. And the people who are prepared are the ones who buy generational opportunities. Now I want to hear from you. Do you currently have more than $250,000 in a single bank? Are you taking action? Or are you waiting for more confirmation? Drop in the comments. Because this community isn't here just to watch information. We're here to act. And if this breakdown helped you understand what's happening, hit subscribe and turn on notifications. Because this channel exists for one reason: to tell you what the mainstream media will not touch until it's too late. 3 banks have failed. The FDIC is below its legal reserve floor. The reserve ratio trap is closing, and your deposits are not as safe as you've been told. The only question left is simple. Are you going to act now, or are you going to wait until the system forces you to?